Can the Reliance Nippon Life Prosperity Plus plan effectively address both investment and insurance needs? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what this policy is about. So, this is a unit-linked non-participating individual life insurance plan, and some of the key features of this policy are: you can enjoy life insurance coverage throughout the policy term, you can select from various investment strategies tailored to your financial goals, customize premium payments with options for a one-time payment or installments over 5, 10, 15 years or the entire policy term, receive rewards for long-term investment through loyalty and maturity additions, you can access your funds flexibly with the systematic withdrawal option. You can also build wealth with the returns linked to market performance. Now let's move on to understanding the benefits available under this plan. So first let us take a look at the death benefit. So in the unfortunate event of death of the policyholder, the nominee shall receive either of these three options, whichever is highest at the time of death, that will be given as the death benefit to the nominee. Now the maturity benefit will be the aggregate of these three values mentioned on the screen. So you will have the option to receive your maturity benefit as a lump sum or as a structured payout using the settlement option. And you also have loyalty addition as a benefit in this policy. So loyalty addition of 0.7% of the average daily base fund value of the preceding 12 months are added at the end of every policy year starting from the 6th policy year till the penultimate policy year. So maturity addition of 1.4 of the basic daily base fund value of the preceding 12 months will also be allocated at maturity as a maturity addition. So these are the benefits available under this policy. Now let us take a look at the fund options available under this plan. So the fund options available are Life Large Cap Fund, Life Equity Fund 3, Life Pure Equity Fund, Make in India Fund, Life Balance Fund 1, Life Corporate Bond Fund 1, Life Money Market Fund 1, Life Mid Cap Fund 2. Now all these fund options are categorized based on the percentage they are given to the asset classes like equities, debt, money market, and also according to the risk profile they are categorized into. So whichever suits you, you can invest in it. And this policy has 6 investment strategies like self-management option, systematic transfer plan STP, auto-managed option, target maturity option, and life stage option and trigger portfolio option. So these are all the investment strategies available under this plan. Now let us take a look at the various charges present under this policy. There are no premium allocation charge, but there is a policy administration charge which will be deducted by cancelling units proportionately from each segregated fund at the beginning of each month. So the charges are subjected to a maximum of 500 rupees per month and 6,000 rupees per annum. And mortality charges are charged for providing you with life cover, which will be deducted from the base fund value and the top-up fund value on a monthly basis at the beginning of each policy month using 1/12 of the mortality rate. And there is also fund management charge where they will charge you for managing your fund based on what kind of fund you have chosen, and according to the risk profile that fund has, the charges will vary. So the charges vary from 0.50% to 1.35%. So the higher the risk, the higher the fund charges. Another thing is the partial withdrawal charge. So 2 partial withdrawals in a policy here are free, and 100 rupees will be deducted from the fund withdrawn on every extra partial withdrawal. You also have discontinuance charge, which depends on your year of discontinuance, premium amount, and premium paying term. There are no discontinuance charges from the 5th policy year onwards. There is also something called switching charges. There are 52 free switches during any policy year and 4 free switches per year during the settlement period. So subsequent switches, if any, will have a fixed charge of 100 rupees per switch. So these are the various charges present under this policy. Now let us take a look at the advantages and disadvantages of investing in this policy. So let's start with the advantage. So top-up premiums are permitted. Partial withdrawals from the base fund value are allowed after 5 policy years or when the policyholder turns 18, whichever is later. The systematic withdrawal option enables automated withdrawals of a specified percentage or amount from your fund. With the self-managed option, you can switch between 8 available funds and redirect your premiums. Maturity benefit can also be received as a lump sum or through structured payouts using the settlement investment option. Riders can also be added to enhance the base policy. So these are all the advantages of this policy. The disadvantages are this plan does not offer a loan facility. Liquidity is restricted during the first 5 policy years. The net premium is invested only after deducting applicable charges, and while the plan reimburses the policy administration charge, it does not account for the time value of money. So these are all the advantages and disadvantages of investing in this policy which you need to carefully consider before deciding to invest in it. Now, as we have a basic understanding of this policy, let's move on to the analysis part of the video where we are going to estimate the potential returns, which is the internal rate of return IRR, which is very crucial when assessing a market linked product as it enables comparison with other investment options and aids us in making informed decisions. So let's analyze this plan using a sample quote from the policy brochure. So let us consider, just for example, that a 35-year-old male opts for this plan with a sum assured of 15 lakh. The policy term and premium payment term are set at 15 years with an annual premium of 1,50,000. At the end of the term, the accumulated fund value will be paid out. The projections are based on assumed investment returns of 4% and 8%. So these are just to show you the worst and best case scenario. They are neither guaranteed nor indicative of the maximum or minimum returns possible under this policy. This is simply for an example purpose to give you a better idea. So at 4% interest rate, in the worst case scenario, the estimated fund value is 28.32 lakh, translating to an internal rate of return of 2.82% as per the policy's maturity calculator. At 8% return rate, in the best case scenario, the estimated fund value is 39.21 lakhs with an IRR of 6.67% as per the policy's maturity calculator. So despite a 15-year policy term, the returns may not be suitable for a long-term investment strategy. With inflation likely to increase the cost of financial goals, the returns from the Reliance Nippon Life Prosperity Plus plan may fall short of keeping pace. This indicates a potential gap in achieving the desired corpus if this ULIP is chosen. So now, as this policy is not giving us a desirable outcome considering the disproportionate risk and return in the policy, let's explore alternative investment strategies that offers us better risk adjusted return. So while ULIP combine insurance and investment, now we are going to separate this component to see whether it can be a more efficient approach to investment or not. So using the same parameters as before, let's analyze two scenarios. So for example, for life coverage, we have opted for a pure term life insurance policy with a sum assured of 15 lakh cost 7,100 rupees annually for a 15-year policy term. In the previous example, the total premium was 1,50,000. Opting for a pure term policy which leaves us with 1,42,900 available for investment. Investment choices can vary based on risk appetite. So risk-averse investors may consider debt options like PPF, and if you are a risk-tolerant investor, you can explore equity investments like ELSS fund. So in the PPF investment, the estimated maturity value is 38.75 lakhs with an IRR of 6.54%. This return closely matches the 8% scenario of the Reliance Nippon Life Prosperity Plus plan. So despite being a debt instrument, PPF provides us with better returns than the ULIP at the same assumed rate. And is an ELSS investment, you can see the estimated pre-tax maturity value here is 59.66 lakh. After accounting for capital gains tax, the net maturity value is approximately 55.04 lakhs with a post-tax IRR of 10.55%. This analysis here highlights that separating insurance and investment can deliver significantly higher returns, facilitating greater wealth accumulation and faster financial growth compared to the Reliance Nippon Life Prosperity Plus plan. Now, what is the final verdict on the Reliance Nippon Life Prosperity Plus plan? Is it worth investing or not? As you can see, this policy combines life insurance coverage with market-linked investment. However, various charges significantly reduce the investable amount, impacting overall return. So, our analysis reveals that the plan's long-term returns are relatively low and do not justify the associated risk of a market-linked product. Moreover, the sum assured under this plan may fall short of adequately meeting a family's basic needs, potentially disrupting your long-term financial plan. So, as a result, the Reliance Nippon Life Prosperity Plus plan is not an ideal option for either life insurance coverage or wealth accumulation, and it also has a high agent commission. For life insurance, a pure term policy is a more effective solution, providing essential financial protection for your family. To achieve your financial goals, it is essential to build a diversified investment portfolio across asset classes, which can help you navigate complex financial conditions and grow your wealth. So, choosing the right insurance and investment product requires through thorough evaluation. So, definitely, after better evaluation, come to a conclusion which will suit you best.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.